20%. Now, onto the earnings files. We are awaiting earnings from Rivian as well as Lyft. We are expecting earnings from Rivian, as I mentioned, as well as Lyft. Now, Lyft will be interesting, especially in the context of the last quarter, which we had that big typo. They said margins would expand by 500 basis points. They met by 50 basis points. We've got Mark Mahaney joining us for instant analysis. Mark, the numbers haven't come down yet, but give us a sense of what to expect, because the performance in Lyft versus Uber has been very divergent.
Well, both stocks have done reasonably well year to date. Lyft is up 10% and Uber's up 14% or something. So, relatively similar, modest outpacing of the market. But over the last couple of years, last year and a half, you're right, there's been dramatic outperformance from Uber because it's considered to be the market leader in North America, and it's diversified into international markets much more so. By leagues than Lyft. And it's also got diversification into delivery, and it's generating more free cash flow. It hit the free cash flow inflection point earlier. So there's just a lot of reasons why it's to date has been a dramatically better asset, fundamentally, financially, and that's why its stock performance has been better. I think it's been pretty clear cut.
I've got the earnings coming down now. I'll go through it now. Lyft's loss per share coming in at 8 cents versus a loss per share of 50 cents last year. Adjusted EBITDA coming in above expectations of nearly 60 million. The market was looking for 54 million. I know that the key number is gross bookings, and for the first quarter, that coming in above expectations and higher than what we saw in the same quarter last year. Gross bookings coming in at 3.69 billion. The market was looking for 3.59 billion. When I look to the forecast, however, for gross bookings, that seems to be coming in a little bit light, Mark, 4 billion to 4.1 billion. The market was looking for something 4.02 billion. So maybe we can call that in line. Active riders a little bit higher than expected, 21.9 million. The market was looking for 21.7 million. So on the face of it, it looks like bookings beat expectations. The forecast for bookings we can call in line. That stock, in the initial reaction, we are seeing the stock trade up by as much as 5% right now. And as we get further details, we'll watch to see how that evolves. Lyft also talking about its ability to convert adjusted EBITDA to free cash flow. They see about a 70% conversion for 2024. And they did a few more rides than the market was looking for, 188 million. If we round up, the market was looking for 186 million. So generally, this looks like, Mark, kind of a beat across the board and maybe a bit of a feather in the cap of a CEO that's marking 1 year in the job.
Well, it looks like maybe a modest beat and bracket quarter. That's how I kind of phrase it, rather than kind of a straight out beat and raise quarter. So stock goes up. I don't think it's a huge move up. Some of those metrics that you mentioned are a little bit better than expected. I haven't gone through it in great detail yet, but you would have expected reasonably good results from the company. Did we have some read-throughs? We did listen to DoorDash last week. Now, that's not a mobility company, but it certainly, some of the supply dynamics there are very similar to what Lyft and Uber would see. And those results from DoorDash showed kind of continued consistent growth in supply and in demand. So you'd have expected Lyft to participate in that and see that as well. And that's kind of what we've done. So I think these mobility trends, which have really been recovering, improving for a solid 2 years post-COVID, it looks to me like they're continuing to recover. And I think we'll hear the same thing from Uber tomorrow morning.
Yeah, to what extent, you've got an inline on Lyft, but an outperform on Uber. To what extent is Lyft a read-through story for Uber versus, has Uber really been taking market share from Lyft?
I think it's hard to know, but the market share, we think, between the two has been relatively stable over the last several years, frankly. It's about a 70-30 split in North America. Uber, the 70%, Lyft with a 30%. Frankly, it's really hard to see how Lyft could materially gain market share. Like, what price or product innovation could they introduce that would materially gain share that Uber wouldn't react to. So I think these kind of share differences between the two are likely to stay consistent for the foreseeable future. If I had to worry about anything, I'd worry about Lyft sort of modestly losing market share over time to Uber. But to your first question, yeah, I think Lyft was kind of a positive read-through for Uber. Look, I prefer Uber as a stock. I know Uber's more expensive as a stock or less cheap than Lyft. I get that. I just think it's a higher quality asset that is Uber. Bigger addressable markets, more diversification, a bigger free cash flow. They're buying back a lot of stock, S&P 500, company. I just think there's a lot of positives for it. And I view really Lyft more as a trading vehicle. But the trends are positive here at Lyft. So I think the outperformance that you've seen in Lyft shares year to date, the modest outperformance, I think that continues.
And I mean, zoom out, because you cover such a broad swath of tech, everything from Amazon to Meta, including Shopify and Airbnb. Would you say kind of coming through the tech earnings season that hugging towards quality has become a little bit more important in this market, in this version of the cycle versus betting on more speculative tech?
Yeah, I would completely agree with that statement. Your implied statement there. Yeah, I think you've the larger assets can afford to invest in these things like Gen AI and pay for the capex to really run that at scale. So that's the advantage to Google, Meta. And Amazon, and then you're starting to see but you are seeing some broadening out of the performance to names like a Pinterest, but they have to have really strong product cycles. I just think Pinterest does have a very strong products cycle here. It's actually my favorite mid cap stock. And then the travel names. We've had a tale of two cities so far. We'll get Airbnb later this week. The tale of two cities is the tail up, or the positive tail, or the shining tail city, whatever, was Booking, and the city with challenges was Expedia. But the underlying demand trends were positive for both names. So I kind of see that across the board. If there are any kind of broad themes, it's hard to do that in a very diverse group, which is the internet. But demand trends are as good as or better than you saw last year in 23. Margins, so that's top line, that's revenue. Margins are the same or better than last year. That's because you had layoffs and nobody's rehiring like it's 1999. You're getting a lot more shareholder-friendly activities, more dividend payers, more buybacks. And then finally, this AI impact for digital-first companies like most of the internet names, it's a tailwind. So I like the sector. We've had a reasonable rally, pretty strong rally in the stocks over the last 12 months. So I think there are very few dislocated back up the truck, price offerings here. There's just a few names that we continue to like, and we view them as compounders.
What about Meta? I guess you had this moment in time to buy on the dip, which you do have an outperform on. Investors definitely did flinch at those spending plans, although the stock has recovered somewhat.
It has, and I call that an expectations correction. And my history of picking these tech stocks and growth stocks is you look for these corrections and you have to answer for yourself, was that an expectations correction or a fundamentals correction? And the more that it's an expectations correction, that's what you want to buy. That's the dip you want to buy. Now, we've had some things that are bigger than just dips with Meta over the last couple of years. We had a dramatic crack in the stock 2 years ago, but that turned out to be a great buying opportunity. I don't know that the recent correction is a great buying opportunity, but I think it's a good one. People are concerned about the revenue growth outlook at Meta, and then the rate at which they're investing in spending on capital expenditure dollars on AI. But Meta has proven to me, and I think Google has too, and Amazon has too, that they know how to invest and get a good return on their investments. And I think if you're one of those mega cap names, hyperscale names, you should be investing in AI, and you'll probably get a pretty good return on your ad spend. So if the stock wants to trade off on that, I'm usually going to step in and want to recommend that people buy that dip.
Before I let you go, we were mentioning Shopify reports tomorrow. This is one that you're neutral on. Why?
Valuation, probably more than anything else. We've also had some strategic shifts or shifts in the strategy, if you will. They were going to vertically integrate, and then they weren't going to vertically integrate into logistics. And so sort of feel like I want the company to kind of figure out what it wants to be when it grows up. But that's too quick of a statement. I generally am very respectful of the fundamentals of the company, management team of the company. It is it's one of the more expensive stocks I cover. So I really like kind of a more attractive valuation setup on Shopify. But the play that it is on online retail growth, I think, is extremely solid. And then the way they've been able to layer in more and more revenue streams, kind of attach rates to the core business, I think has been very impressive. So I generally have a positive bias for it. I'm just sort of waiting for the right moment, the right correction to step in on.